Post-election market rally taking a bit of a breather today as investors prepare their portfolios for 2025 and the incoming Trump administration. Our next guest says private markets need to be a part of your allocation. So joining us right here on set is Ares Wealth Management Global Head Raj Dhanda. Raj, it's great to have you. Welcome.
Morgan, great to be here.
Let's start right there. When it comes to making the case for private markets in retail investors' portfolios, what is it?
Well, it's really simple. They're just too large to ignore. You know, the democratization of alternatives is important in that it sort of sets the backdrop. There's more access, there's more education. But fundamentally, the private markets really dwarf the public markets in size. If you simply look at the breadth, there's 20,000 companies that have over 100 million in revenues, 90% are private. And so you really are, you really can't invest if you're not thinking about the private markets. The way we think about it is it's not an alternative anymore. The private markets have such diversity. That was how we would go to the public markets originally, to find a diverse set of opportunities. Today, it's the private markets that provide that diversity. And
when we see stock market at record high or hovering right near record high, it does seem like the 60-40 portfolio is working again, finally, for the first time in a while, at least for now. So when you do look to the private markets, what's compelling, especially as you do look to 2025 and a new administration that, at least right now, seems to be igniting animal spirits?
The 60-40 narrative is increasingly dated, and in our narrative, that's 100% to the public markets, 0 to the private markets. There's day trading, and then there's wealth management, and they're very different things. Mm-hmm. The private markets really solve several different client issues. Durable income is lacking today. Some sort of a defensive instrument, and so private credit has filled that and will continue to be a solution. So many wealthy individuals have really concentrated risk, and so the diversification of secondary strategies is solving that issue. And then tax is a solution that's lacking often, and particularly in the public markets, it's very hard to have tax-efficient solutions. The private markets do that really well for real estate and infrastructure.
Raj, thanks so much for being with us. My question has to do with, I guess, a category of wealthy individual that's maybe not your typical wealth management client, but is now being pitched this private market idea. And I guess my concern for that person, that family, is around liquidity and transparency. It's going to be a little bit less than they're used to, and just being able to look at an app and see what the price of your stock portfolio is, right? So how much education preparation does there need to be for that potential private market investor?
Yeah, it's a great question. In fact, the dialogue around liquidity, around volatility, correlation, is driving a significant amount of the flows into the wealth channel for alternatives. So we find the perfect place to start is to have a conversation around a client's goals and think about what is the liquidity they need. Inevitably, and for decades, retail investors have overpaid for liquidity. They'll have 90% of their portfolio in liquid assets, and the top financial advisors have to spend an inordinate amount of their time keeping the clients invested during the downturns. So after you've done appropriate liquidity planning, alternatives still will be, and the private markets will still provide great solutions for a higher risk-adjusted return. Volatility is another discussion we have all the time, where the volatility can be a distraction. Correlation is a conversation we have all the time in our education, thinking about what's the right construction in a portfolio that addresses the client's goals.